Welcome to another Taking Stock episode for the week ending the 6th of December 2024. I'm Kentrin, Head of Research at Stock Doctor, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to your thing share market. Welcome, Jace.
Thanks for having me, Ken. It's great to be back on again.
Yeah, it's great to be back on, Jace. And just before we get started, though, just a quick yet important reminder, the information we provide during this episode is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so charts or tables presented today shouldn't be relied upon as a guide for future performance. Well, Jace, markets keep on keeping on as the year winds down. The markets have climbed to new highs, and in November, when we're looking back at that month, the Australian market rose by about 3.4%. It's incredible, Jace. And that's
Hmm.
been buoyed by a strong US market where the S&P 500 actually gained 5.7%. And that's marked the best month of the year for markets. Then some of the key drivers last month included the Republican sweep in the US elections, with Donald Trump winning, which boosted investor confidence through the expectations that corporate tax will be cut and also through deregulation as well. Additionally, you had the US tech stocks, particularly semiconductor companies, surging after NVIDIA's strong earnings report.
Yeah, it is a pretty interesting dynamic in what's happening in the US as well. And remember that, Ken, the US Fed has also reduced interest rates by 25 basis points as well last month. And this was despite robust economic data showing a 2.8% GDP growth in the September quarter. And this has somewhat eased recession fears. Contrast, Australia's sluggish 0.3 GDP growth for the same period was largely driven by government spending rather than consumer activity. And this difference underscores why US earnings trends tend to be more favorable right now compared to those of Australia.
Yeah, certainly Australia is lagging behind in terms of the earnings trends, Jace. But
Hmm.
despite the strong market performance, our star growth stocks shone even brighter last month, rising by about 5.6% in the November month. And that brings the total year to date return to around 29%. And that's also outperforming the broader market index by quite a lot, 5%. So it's great to see, Jace, that our star stock selection process has returned to outperformance, especially following a challenging period for growth stocks when interest rates rose quite rapidly a few years ago.
Yeah, and the performance has been pretty good also in star income stocks as well, Kian, which matched the market's performance last month as well. And this is quite impressive, Kian, considering that the strong performance has been concentrated around the tech sector, which often offers lower dividend yields. So for the year, our star income stocks are up 16%, and the yield is around 5.5%, which is significantly outperforming cash and also bond investments as well.
Yeah, so that's good news for income investors, Jace. But let's now turn our attention to some star growth stock highlights over the week with notable share price sales we saw from Pro Medicus co-founder Sam Hubert and also Anthony Hall, each selling 1 million shares, representing less than 4% of their holdings. Similarly, Andrew Hansen of Hansen Technologies, he sold a 3.4% stake through his trust as well. Now, Jace, are these signaling red flags, or is this something not to be really concerned about?
Well, I think in both cases, you have to look at it on a relative sense, Canned. So,
Mhm.
for example, with Pro Medicus, the company stated that the share sale was part of a progressive effort to improve liquidity, with both founders still retaining combined 46% stake in the business and also confirming no further sales. Remember, prior to this, Pro Medicus secured a major contract with Trinity Health, and this has resulted in earnings upgrades as well, and also consequently a lift in the share price. For Hansen Technologies, Andrew Hansen's sales was for portfolio diversification. He still retains a 10% stake and has no further intention to sell any more stock. So, from my opinion, in neither cases, I don't think there's any operational concerns, and this is reflected in the positive earnings trends that we've seen under Golden Rule 3.
Yeah, both these stocks have done incredibly well for investors. But moving from technology to consumer staples, Woolworths supermarket chain, they face challenges this week as workers blocked access to their distribution sites in Victoria and New South Wales, demanding higher pay and also the removal of productivity rules. What's the potential earnings impact here, especially with the company already experienced some negative earnings revisions?
Yeah, it's been a pretty bad case for Woolworths, Ken. I mean, I was just at my local Woolies at the start of the week trying to buy some ice cream for my kids, and the shelves were totally bare. So it's a very interesting scenario right now. I mean, the company estimates that 2 weeks of industrial action has literally cost them $50 million in sales from the supermarket. And also considering it's $68 billion in annual revenue, a few weeks of disruption, including additional transport costs, I guess if you look at it from a holistic sense, should have a limited impact on earnings. But Woolies has implemented contingency measures, and this is including building up stock at stores and also asking suppliers to deliver directly to stores in order to bypass some of these operational issues.
Yeah, we're certainly watching this risk quite closely. But I noticed, Jace, that another impacted business is drinks and hotel operator Endeavour Group as well, which still relies on Woolworths for distribution to some of their stores despite delisting from Woolworths in 2021. Now, earnings revisions are also negative for Endeavour Group as well. What is the impact here?
Well, there are some shortages at some stores. However, the impact should be even less. There is also an opportunity for Endeavour to make a claim against Woolies if the earnings impact becomes more substantial. I guess from a positive note, Star Income stock Coles could potentially benefit from this as they could take market share, given that consumers might pivot their spend towards other channels. And also, the company recently launched an advanced online fulfillment system, and this could implement some form of AI to streamline the ordering process and delivery as well. So that could give Coles a little bit of an advantage. Furthermore, the company also offers a high gross dividend yield of around 5% compared to Woolies' 4.6%. It is somewhat slight, but given the current circumstance, we could say a little bit of a pivot towards Coles.
Certainly, Coles could represent an opportunity here for investors, Jace. But moving along, our team initiated coverage on building materials company James Hardie over the week, but the earnings growth profile is expected to be flat this financial year. So, why have we initiated coverage on them now, Jace?
Yeah, it's a good question, Ken. Look, we've always looking for opportunities, as you know, Ken, in the research team, and this is following the removal of tourism operator Kelsian and also some of the lithium stocks that we saw last week. From an operational perspective, James Hardie is on a non-standard fiscal year end in March, so we've focused on its FY26 outlook, which shows pretty strong growth, and this is despite some of the cost pressures we've seen, especially from pulp pricing as well. The company has exceeded margin expectations in North America, and this has driven most of its revenue growth, as reported by management in their recent trading update. Positively as well, Kim, we've also noticed that the lower end of its net profit guidance has also been increased, and this has prompted some of the positive earnings revisions that we've seen from analysts as well. However, investors need to know that the key risk remains in Europe, especially in Germany, where conditions remain a little bit tough. However, if you balance that, it's only 4% of total group revenue. So we feel like it's still relatively minor at this stage.
Yeah, sounds like James Hardie is positioning itself well for both a recovery and growth here, especially with interest rates still resuming its cuts. And also, you've got the election uncertainty over in the US. Also, I noticed that they announced a 300 million buyback program, which reinforces its strong capital position as well. Now, Jace, early in this week, we initiated coverage on Bank of Queensland due to this strong bank reporting season. What are our thoughts here?
Well, Ken, the bank did report some weakness, including the inability to compete with major banks due to lower credit rating and also a high cost structure. But the bank is making inroads to improve its future profitability, and it has been transitioning all of its owner-managed branches to a corporate-owned branch system. And hopefully, this can be achieved by March 2025, which should set itself up for pretty good growth moving forward.
Yeah, certainly some restructuring going on there. But I also noticed it is rolling out the digital mortgage platform to strengthen our operations and expand its higher margin business banking segment
Hmm.
to drive growth as well. So the bank now is currently on a gross dividend yield of around 7%. So perhaps an opportunity here as well. This week in Under the Microscope, we take a look at Fisher and Paykel Healthcare. The code is FPH. It's a global company in the medical device industry, the share price has been on a tear, Jace. And can you provide an overview of the business and how it differs from its home appliance brand?
Yeah, Fisher Paykel Healthcare designs, manufactures, and also markets medical devices for respiratory care, acute care, and also obstructive sleep apnea treatment as well. And this is entirely separate from its Fisher Paykel Appliances business, which makes household products like refrigerators and so forth. The two companies separated in 2001, and this has allowed Fisher Paykel Healthcare to focus exclusively on healthcare solutions.
Yeah, that's an important distinction there, Jace, especially because a few people get confused between the two. I noticed that it operates in a similar space to Star Growth Stock ResMed. So, how does Fisher and Paykel compare to its competitor like ResMed?
Well, it's a very good question, Ken. Both of them operate in the respiratory care and also sleep apnea treatment space. However, their approaches differ quite a bit. Now, ResMed is best known for its CPAP machine or continuous positive airway pressure machines and the digital health technologies that are associated with that machine as well. Fisher and Paykel, on the other hand, have a broader product range, and this includes respiratory humidifiers and also neonatal care devices as well. The diversity allows Fisher and Paykel to address a wider range of healthcare needs rather than the more specific ones that ResMed caters to.
Yeah, so earnings are more diversified towards a number of different healthcare products here, but I understand Fisher and Paykel also has a strong record of innovation, consistently introducing new products that meet changing healthcare demands as well. Meanwhile, its global expansion strategy has been quite effective with products sold in about now 120 countries. This is contributing to its strong growth profile, like return on equity and also its high net profit margins.
Yeah, that's right, Ken. I mean, the company benefited greatly from the COVID-19 pandemic and which drove a huge increase in demand for its respiratory care products and has boosted sales and earnings as well. However, this has sort of moderated over the past couple of years and conditions have now normalized, but it has been an outstanding performer during that pretty concerning period.
Yeah, definitely normalization in the period, but it still is expected to grow quite strongly over the next couple of years. But with the recent share price rally, the stock continues to trade close to fair value based on an average of around seven analysts here. But looking at its PE multiple, though, Jace, it is trading at a premium to the healthcare industry. But
Mm.
as we've said before in the past, investors really need to sometimes pay a premium for quality businesses like this with strong fundamentals. So, Jace, are there any risks here that investors should be potentially mindful of?
Well, with every company, there's
Mm.
always certain risk, and Fisher and Paykel's risks are very similar to those of ResMed, and these could include some of the stringent healthcare regulations that we've seen globally, which could impact operations and lead to potentially product recalls, which ResMed has benefited from, and when its competitor Philips had undergo that recall. Also, as well, there is a heavy reliance on international market exposure which includes currency fluctuations when you translate those back into Australian dollars or New Zealand dollars in the case of Fisher and Paykel. Other risks obviously include intense competition from peers and also any supply chain disruptions, which could lead to potentially higher costs.
Following the share sale from the founders, Pro Medicus and also Hansen, a useful question this week is how can investors assess the risks of a director or founder share sale?
Well, it's a really good question, Kian. When founders and directors sell shares, investors must critically evaluate whether the sale indicates potential risks to the business fundamentals. And one of the ways they can assess this is to review the company announcements for insights into the rationale behind the director sale. Often, these explanations can sound a little vague, so they sometimes cite personal reasons, tax obligations, or also improve share liquidity. Now, this is when an investor needs to read between the lines to see if the explanation holds muster. However, you should not just base your conclusion on management explanation alone.
Yeah, you also need to assess the proportion of the shares being sold relative to the director's overall holding as well. Retaining a significant stake suggests continued alignment with shareholder interest and confidence in the company, as with the case of Hansen Technologies and also Pro Medicus.
Another way would be to assess the share sales timing in relation to any company events. So, for instance, selling shares before an earnings release could indicate potential conflict of interest on any upcoming unfavorable news that could come out of the company. Another way to potentially review it is to have a look at any historical share transactions. And you could easily do this within Stock Doctor. You can examine the director's previous share selling behavior. So, for example, consistent small scale sales, like those of WiseTech founder Richard White, might not signal much of a risk at all. Conversely, a pattern of really aggressive selling before any news could be a potential red flag.
Yeah, we've seen this in the past, Jace. Certainly occurred with some stocks that we've seen, like Kogan or even Satire, those online retailers. But you can also verify the business fundamentals on Stock Doctor, ensure the earnings revisions under Golden Rule 3, for instance, are positive. When you've got stable or improving fundamentals, that can mitigate concerns raised by share sales as well.
That's right, Kien. And also look for any similar sell downs by other insiders or institutional investors as well. Or another factor that you could look at is rising short interest under Golden Rule 4, which could indicate negative sentiment amongst hedge funds.
Yeah, by combining these factors and those investors can make more informed judgments about whether a director or founder share sale signals a risk to the underlying fundamentals of the business. But that's all we have time for today. Thanks, Jace, for your insights once again.
Always a pleasure, Kien. And if members have any questions, they are always free to contact the Stock Doctor research team, and we're always happy to take any questions.
Yeah, definitely. And so just to conclude, take care and have a happy, healthy, and prosperous week ahead.